Following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
And it's Saturday. We're going to be talking about money. This is The Answer About Money. I've been doing a series on the question, is COVID the Pearl Harbor moment of our lifetime? This is the third one in the segment, third one we're talking about. And so let me repeat one more time. Pearl Harbor, what was it about? World War II. Pearl Harbor changed so much. There were dramatic changes in nuclear, in computers, in pharmaceuticals, in radar, jet engines. All of that grew out of World War II. Some have been discovered before, but World War II gave dramatic changes. There were dramatic changes in lifestyles. The GIs came back, went to college. They went to college on the GI Bill. They started their families. Home building took off and skyrocketed. The highway system, the interstate highway system, came out of that time being built. So did airports, and so did aviation take off at that time. And media. Up until that time, radios. Radios continued to be for a long time, but replaced by TV. And you began to get international news as well. And there were dramatic changes in demographics. Life expectancy began to increase, dramatically increase. Women entered the workforce in significant numbers, adding significant brain power to what was already there. There was an exodus from the city centers to suburbia, and there was a migration from the older cities of the Midwest to the West and to the South. All of that happened. It had significant changes, significant impact on investments, significant impact on what was going on in the economy, dramatic changes in technology, in lifestyles, in demographics. I believe, and I've been sharing why I believe the same thing will happen following COVID. We'll see dramatic changes in technology. We'll see dramatic changes in lifestyles and dramatic changes in demographics. The first couple programs, I talked about the changes going on in energy. Because energy, when you think about it, is the largest single industry. It dwarfs almost every other industry. It's annually between $7 and $10 trillion of revenues. If you look at media, as I compare it to media that were on the radio now, the radio, TV, the movies, magazines, newspaper, everything that's involved with the media is less than $2 trillion a year. Energy, $7 to $10 trillion a year. So, began to talk about it, talked the first week about solar energy. Solar, just 2% of all of our electrical energy needs now, growing at 30% a year. When you talk about the compounding growth, that means that solar could furnish all of our electrical needs within 18 years. Within 2 decades, solar could furnish all of the electrical needs we need. And last week, of course, I talked about dark energy. And if you went to high school or college, prior to the 1990s or the 2000s, most people had never heard of dark energy. I made the analogy of our bodies. Our bodies contain cells for the skin, for the bones, for the organs, all those cells we have. But if you look at the human body, that comprises less than 10% of the cells in our body. We're not even aware of the other 90%, more than 90%. We only become aware of it when we get sick. 90% of the cells in our body are bacteria. We're never even aware of that going on. Dark energy makes up 68% of the universe. It's something that we've seen, the astronomers have seen, people looking into the space have seen, that light is being bent. Something out there is bending light. And the only way to explain it is with a weakly interactive massive particle, a WIMP. That's the theory behind it, is that we have dark matter and dark energy that is out there. In space, there's no atoms. So there's something out there that causes light to bend and explains the chemistry of the universe, explains the expansion and the rotation of the galaxies, explains what's happened from the time of the Big Bang when the universe began to expand as it has. There has to be an explanation, and these WIMPs, these weakly interactive massive particles, are the theory that physicists have proposed. And of course, I made the analogy as well to Peter Higgs in 1964, looking at particle physics, proposed there had to be a particle he called the boson particle, called the Higgs boson particle. It was theory, it was not proven, but it explained particle physics. And that became known as the God particle, because that had to exist for all the theories that grew up around particle physics. And of course, on July 4th, 2012, the Higgs boson particle was actually seen and identified in the accelerator in Switzerland. It was proven to exist. Had it not been proven to exist, all those theories about particle physics could be thrown away. If WIMPs are proven not to exist, all our theories about what's happening in the universe will probably be invalid. But the chances are physics has one set of principles, one set of laws. And those WIMPs explain what's going on. And that's an energy source we haven't even begun to tap. We've just begun to identify. How soon before we do that? I don't know. Is it 5 years? Is it a decade? Is it 2 decades? I don't know. But 68% of the universe consists of dark energy. Huge potential to see us continue to grow. That was last week. This week, I want to focus on a different industry. I want to talk about robotics. When you think about what's going on, one of the countries that's leading in this field of robotics is Japan. A few years ago, they realized that they had a real issue as their population was getting older. As their population at that time, men were living to age 80, women to age 87, and they were expected by 2025 a shortage of 4 million healthcare workers. You know, they don't accept immigrants into Japan, and the healthcare workers are a job where it's low paid. It's a difficult job. So Japan came up with the idea, and the Japanese came up with the idea of building robots to become supplemental to the health givers they had. And they've done that. They've built robots. They built the HSR robot. It's a human support robot. And I'm using one example. We're going to talk about even a wider range. But the HSR assists in nursing, independence, and daily life. The HRS can actually pick up and carry things and carry individuals. It can carry a person and toilet a person who's in a nursing home. Think about that. It can work in the homes of the elderly, allowing them to live much longer in their own homes before moving into assisted living or into nursing homes. But robots, R2-D2, C-3PO, they're metallic. They may be fun to talk about and see in Star Wars, but they don't have the human qualities. So Honda's built a cuddly little robot which you can talk to, and it will talk back to you. You can carry on a conversation. They've got a WeWalk robot, which is used for rehabilitation. They've got the THR3 robot, which has fingertip control, can play the violin, can play the trumpet, and it can do the dishes. It can vacuum the floor. It can take care of a lot of household duties. All of those robots have been built and are functioning. And Honda's built a robot which actually is much stronger and physically understands its environment. It can recognize moving objects and avoid moving objects. Responds completely to voice control. They built 310,000 robots in Japan to take care of this, and they're leading the world. That's just one aspect of robotics. We've got a lot more to talk about in terms of expanding this whole thing. That's one example of what's happening in robotics. There's a lot more that's coming. There's going to be opportunities for investment. There's going to be things you can do in robots that are going to be very significant. We'll be coming back and talking more about that. We're coming to a commercial break, so don't go away. We're going to be talking more about the robotic field and the opportunities coming up. Don't go away. Stay with me.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Well, welcome back. I've been talking about robotics. I started this series on Is COVID the Pearl Harbor Moment of Our Lifetime? We saw dramatic changes in technology, demographics, and lifestyles coming out of World War II. We're seeing, I believe, the same kind of dramatic changes in technology, in demographics, and lifestyles coming out of COVID. Life is going to change. How does it change? And what are the potentials for investments? Talked about energy in the first two segments. I'm talking about robotics, and I gave one example. Robotics growing up in Japan, talking about caregivers. But there's actually more than just that that's going on. There's 6 types of robots. There's the most basic robots. They're just stationary or semi-stationary. There's they're industrial. They can do repetitive tasks. They can put the tires on the car. They can screw in the bolts. You know, those robots can do a lot of factory work. Warren Bennis famously observed that the factory of the future will have only 2 employees, a man and a dog. The man will be there to feed the dog. The dog will be there to keep the man from touching any of the equipment. That's the factory of the future. It's going to be a lot of robotics. That's the industrial robot, and we're seeing so much of that already in place. We're seeing some of the robots in exploration. We saw the Mars rover, remotely controlled from Earth, but being able to move and circulate on Mars. It's a simple probe to automatically do spacecraft. We're seeing those type of robots. We're seeing consumer robots like the Roomba, the vacuum cleaner. We're seeing the Internet of Things. Japan has robots that will do the dishes, that rearrange furniture, that will actually, for chronic medical, make sure that you take the right medicine at the right time and in the right quantity when needed. Medical robots. There was on the program the inventor of the Da Vinci robotic surgery, doing prostate or hysterectomies or kidneys, an actual robot manipulated by a human being, but doing a surgery. I know of men, for example, who have had a prostate surgery They've missed work for 2 weeks. With the Da Vinci robotic surgery, they do 3 little holes. They drill that in, and you're almost ready to go back to work the next day. That's the difference that makes. It's a robot that senses the tension. It can sense skin and pushback in the skin, and a very significant reduction of risk of that surgery. We're seeing mind-controlled prosthetics. We're seeing miniaturized robots. We're seeing drones. Those are essentially robots that are able to fly. We're seeing military aircraft driven by machines, not by human beings. We're seeing deep sea exploration done with aquatic robots, unmanned boats like the Coast Guard. And, of course, we're seeing the development of automated vehicles, cars that drive themselves. Think of the impact that will have on lifestyle when it's going to be much cheaper just to take a robotic car. You call the car, it takes you wherever you want to go. It's going to be cheaper on insurance. You don't have the insurance, you don't have the car payment, you don't have that whole thing. I'm not so sure how well I like that concept. I like the drive, but we'll see. That's what's going on in robotics. And there are going to be more and more robotic type applications. We're going to see janitors. We're going to see restaurant workers. We're going to see probably 50% of the jobs that are done today will be done in some form or another by robots. And the robots are not just ones that are built and programmed, but they're robots who are able to learn and adapt to their environment. It's going to be huge. It's a huge field. There are going to be investment opportunities, so stay tuned. We'll talk about some of those as the future goes along. With that, I'll be back and talk more about what's going on in this whole question of, is COVID the Pearl Harbor of our lifetime? But right now, I want to introduce you to a rising star at Adams Financial Concepts. She is one of the people you're going to hear a lot about in the coming years. Jen Weynands is one of our very special financial advisors. So with that, I'm going to turn it over to Jen because she's got information to share that I think you'll feel good about.
Awesome. Thank you, Mike. So what I have to talk about today is why the market itself is just not really an indicator of where you want to put your money. So what does the market really tell us? Most people assume that the stock market and prices of stocks reflect the strength of the companies behind them without question. The truth is, this theory has been proven wrong time and time again. The stock market isn't completely factual because people often don't use pure logic to make decisions. Humans are emotional beings. We act on feelings like desperation or fear of missing out or even peer pressure. You can go to a cocktail party and listen to your friend talk about buying the latest pair of Steve Maddens in the same sentence they're giving stock advice. I find both to be great investments personally, but with two very different objectives. It's a widely accepted notion that the stock market tells us when to buy stocks and which stocks to buy. If the stock's price is high, it's a good company and it's a good buy. But if it's low, the company must be in some trouble and you just have to sell it off right away. But that's simply not the case. A great example that I like to use comes from the Netflix series called Dirty Money. One of my favorite episodes is called Drug Short. It talks about how pharmaceutical companies use the necessity of life-saving drugs to make prices incredibly high and, in turn, increase their profit margins. The spotlight was on a drug company specifically called Valiant. CEO Mike Pearson was a super shady guy, not really good at what he does, but he got the stock price to rise super high. He used Wall Street investor Bill Ackman to get money, and all of a sudden the price of the stock just skyrocketed. And it fooled a lot of investors, with the exception of one very smart short seller by the name of Fahmi Quadir. Her nightly reading material had to do with Valiant's business history and subsidiary companies. And the stock finally crashed in September of 2015 after it began to face scrutiny because of overpriced insulin and some bogus pharmacy they came up with called Philidor. Fahmi Quadir has since built her entire career on shorting companies that exploit people. And if she can find success through due diligence, honestly, so can you. But when stock prices don't reflect their true value, it shows that the stock market is actually inefficient. In other words, there's clearly some information that is not widely known, because if it was, the stock's price would reflect its true market value. A lot of times, this comes down to a lack of information among the people who are trading. And one of the most fascinating real-world examples of this was the dot-com era. Remember in the 1990s when the internet started to take hold and everyone and their cousin was investing in internet businesses? People talked about internet stocks the same way they did, well, like their new favorite pair of Steve Maddens. It was super trendy. And don't get me wrong, I'm not discounting the effect the internet has on the world today. I mean, people are meeting online nowadays and becoming each other's fiancés. And I'm a millennial, and I'm still shocked by how often these things happen. The dot-com bubble was created when people began buying stocks of internet companies like they were just going out of style. Basically, the internet was a relatively new idea that everybody wanted to get in on. At the end of it all, most of these companies, such as Pets.com, 360 Networks, and eToys.com, came to a point where they actually filed for bankruptcy. On the flip side, some of the most pivotal growth stocks were born during that era, like Amazon and eBay. With the development of the World Wide Web came a new way of life. All of a sudden, you can go shopping without even leaving your bedroom. And most people would say this market bubble originated from the issuance of shares by a web browser developer known as Netscape. Its initial public offering was on August 9th of 1995, and this company provided a new way to surf the web, a new programming language, which was JavaScript, and we all know how popular that is, and the ability to save browser information through internet cookies. And when it went public, the company was actually losing money and reported revenues that were modest at best. At the end of the day, they still went forward with the IPO, and this was actually wildly successful for them. They started with an offering price of $28 a share and eventually rose to $58.25. And that was just all in the same day. This means that the market capitalization became over $2.5 billion. To this day, that is an astounding number, but can you imagine achieving that in the 1990s? This company was a real unicorn. The overnight success of Netscape seemed to be the one that opened the door for other internet companies to go public. The problem was that nobody was really even paying attention to the fundamentals of the companies they were investing in. In other words, nobody knew the price-to-earnings ratios, the debt-to-equity ratios, or even the amount of free cash flows that were associated with the companies they were investing their money in. And most of these internet-based companies didn't even have a solid business model. A lot of these investments were speculative, but you wouldn't know it by how sure investors were when they took the plunge. Consumer sentiment ended up creating a market of dot-com stocks that were extremely overvalued, and lots of them. In 1986, 677 companies in the U.S. went public. In 1987, 474 went public, and then 476 in 1999. By 1999, 39% of all venture capital investments were for companies on the internet. In contrast, though, after that bubble finally burst, only 80 companies went public in 2001. By 1999, the price-to-earnings ratio of the NASDAQ Composite Index had gone above 90%.
So hang on. You're going to hang on. We'll be back, and you'll hear more from Jensen just right after this commercial break.
Yes, I'll elaborate.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
I'm here with one of the rising stars at Adams Financial Concepts, Jensen Weynands, who's been sharing about the market. Please go ahead, Jen. Tell us more.
Thank you. All right. So I'll pick up where I left off talking about the dot-com era and that big bubble that burst. So where I left off, talking about 1999 towards the end of everything. So by 1999, the price to earnings ratio of the NASDAQ Composite Index had actually gone above 90, which is crazy in the world of stocks. And in comparison, the S&P 500 simultaneously hit a record of 32.19 as a price to earnings ratio. And the University of Florida also reported that the price to sales ratio of companies that went public in 2000 was 48.9. But this actually didn't really make any practical sense. Peter Lynch describes the relationship between a company's price to earnings ratio and its growth rate in his book, One Up on Wall Street, one of my favorites, one of our favorites. He writes, the price to earnings ratio of any company that's fairly priced will equal its growth rate. On page 169, he continues to say, the price to earnings ratio can be thought of as the number of years it will take the company to earn back the amount of your initial investment, assuming, of course, that the company's earnings stay constant. With that logic, investors would be waiting almost 50 years to earn back their investments in these internet companies. And that seems like quite a while for such a hot issue. Plus, the earnings just weren't happening with internet companies. Their money was mostly spent on advertising in hopes that their revenues would eventually catch up with their reputations in the market. It became all about the image and not about the actual profits. .com companies themselves began buying into their own myth. Companies spent money foolishly on lavish luxury employee vacations and quote-unquote .com parties whenever they'd launch new products. Oliver Muoto, co-founder of Epicentric, another .com era software company that was later found to be overpriced, said during this time, but the popularity of the internet gold rush led these parties to grow out of control. These companies spend a whole lot of money on marketing, but end up with people who just want to eat and drink for free. And the Federal Reserve kind of added to the craze. Lower interest rates in the mid-90s only encouraged tech startups to borrow more money in hopes that one day their revenues and profits would finally catch up with their reputations. And finally, in March of 2000, Japan went into a recession and the NASDAQ suffered greatly. Consumer sentiment started to move away from technology stocks as people suddenly realized that profits weren't matching the general public's outlook. The NASDAQ actually dropped 40% during the year 2000, and investors lost a collective trillions of dollars, all because they invested their money based on consumer sentiment and not based on the actual statistics of the companies. Even Amazon stock went from a peak of $100 a share to $7 after the bubble burst. So if investors had done their due diligence, the growth of internet companies would have remained relatively stable and tons of money would actually have been saved in the process. Most members of the general public think that you have to be some sort of business insider or bigwig to do well in the market. In reality, anybody with working knowledge about a company can use the information to their advantage. Going back to Peter Lynch, such a great guy, he discusses in his book, One Up on Wall Street, just by being in the business, you already have an edge on people who are not. On page 100, he writes, the professional's edge is especially helpful in knowing when and when not to buy shares in companies that have been around a while, especially those in the so-called cyclical industries. Side note for those of you who are wondering, cyclical stocks belong to companies that move in the same direction or cycle as the market as a whole. He goes on to say, if you work in the chemical industry, then you'll be among the first to realize that demand for polyvinyl chloride is going up, prices are going up, and excess inventories are going down. You'll be in a position to know that no new competitors have entered the market and no new plants are under construction. All this means higher profits for existing companies that make the product. What I'm saying is that the trick to doing well in the market has nothing to do with formulas or a special kind of brain or super awesome algorithms. Making money in the market comes from focusing on individual companies. This means reading up on the fundamentals. Look at things like the price to earnings ratio, the growth rate, or the debt to equity ratio. Do people even like what the company is doing? Answering these questions will tell you how healthy the company is, and that's what's important when choosing a stock to buy. You're taking ownership in a company when you do that. Would you invest in a friend's restaurant if the food was bad and the service was slow? Of course you wouldn't, because you don't want to lose your money. At Adams Financial, we're forward thinking, and with that comes consistent research and fact-finding. Reading up on a company is not only important before you decide whether or not to invest, but it should be done periodically. fundamental analysis doesn't have a schedule, and that's the approach we take. The end of the year is coming, and most people see that as a sign to reevaluate their portfolios. This is not a bad idea, but don't wait until the end of the year or some marker on the calendar to look into your stock positions. You can do that on your lunch break. And the more consistent you are with your research, the further ahead you'll be, and this leads to better returns and, of course, our main goal, more money in your pocket. You may not end up with a hedge fund like Fahmy Quadir, but if you do your homework and research companies as well as she did, you'll find your own kind of success in the stock market, because in the end, the market itself really doesn't tell you anything.
So thanks, Jen.
Yeah, welcome. That's
great insight. A lot of insight. And don't you agree? Jensen is going to be one of the rising stars in this industry.
Oh.
I truly believe that.
Thank you,
And
Mike. That's nice.
you can find her at 206-903-1019. You can call and talk to her. Set her up as your financial advisor. In talking about financial advisors, it is the end of the year. And I just received a note from a company, and we share information company to company, and so I get information from other companies, and they get our information as well. They read my newsletters. I read some of their newsletters. And what was noticeable about this is they're going through and they're evaluating, as they do every year, their clients. Do you know if you have a financial advisor, you're probably classified? You're classified. So let me tell you about this company. They're a little larger than Adams Financial Concepts, but not a whole lot larger. And all their teams are putting this together. Their advisors are getting together, and they classify each one of their clients. And let me tell you how they classify. If you have $4 million or more in assets at their company, you're considered an A-plus client. And what that means is you have access to the client portal and a holistic view of their your financials. I'm sorry. I'm trying to read my notes of what they said. A holistic view of your finances. You get real-time updates on your financial plans. You get a budgeting plan. You get cash flow analyses. You get a wealth management review. And every month you get a curated content report on the investments and a whole list of planning topics. You get a comprehensive financial plan. And during the year, you'll get three reviews. In quarter one, you'll get an investment review. In quarter two, a financial planning meeting. And in quarter 3 and 4, tax planning meetings. And they also have some sort of surprise event that they will do for their A-plus clients. And their meetings are all face-to-face. $4 million or more in assets. That's what you have to have. That's the kind of service you get if you have $4 million or more. Now, if you have $2 million, so only half as much, you're just considered an A client. And for that, you get a comprehensive financial plan. You get access to the client portal and a holistic view of finances, just like the A-plus clients do. You get a real-time updates on your plan, just as the A-plus clients do. You get a budget plan and cash flow analysis, just like the A-plus clients do. You get wealth management review, just like they do. You get a monthly curated content of your investments every month, and you get the list of planning topics. You only get 2 reviews, not 3 or 4. You do get invited to their surprise events, but the meetings may or may not be face-to-face. If you're A+, they're face-to-face. If you're just $2 million in assets, probably not face-to-face. But sometimes, B clients are those that don't have quite $2 million in assets, but they have the potential to be an A or A plus client. And here you get a comprehensive financial plan. And you get a real update on the plans. You get a holistic view of your finances. You don't have access to the portal. That's only for A and A plus clients. You do get a budget plan and a cash flow analysis, and you get a wealth management review. And you get a monthly curation of your investments, which essentially means you get a statement. And you get a listing of the topics. You get 2 reviews like the A plans do, one during the first half of the year and the second one during the second half, and that's probably a phone call for sure. That is what you get if you're a B client, which means you have the potential to be an A or A plus. C clients are those clients that have at least $500,000 in assets. $500,000. If you're below that level, you're a D client. We're coming to a commercial break. Don't go away. You want to hear what C clients get. A client with over $500,000 but less than $2 million. We'll come back to this in just a minute.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on Adams Financial Concepts. About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, I've been talking about a note I received from a different firm, not much bigger than, well, about the same size as Adams Financial Concepts. We're both SEC registered, and Adams Financial Concepts is now becoming SEC registered. And they classify their clients. A plus, you have to have $4 million or more in assets. A, you have to have $2 million. And B clients are people that have the ability to become an A or A plus. Now, that's not because their accounts grow to that level. That's because you have the ability to add money to your account. You may have only $2 million, or maybe you have only $1 million, but they assume that over a few years you can add another $1 million and get to be an A client. Or you can add $3 or $4 million and get to be an A plus client. But you have to add money to your account to get there. A C client is a person that has $500,000 that probably doesn't have many more assets they can add to their account to get to be a B client. And they get a comprehensive financial plan. They get access to the client portal, and they get real-time updates on their plan. They don't get monthly updates. Actually, they don't get the monthly curated thing on investments. Actually, they get a statement every month. They get a budget and a cash flow analysis, and they get 2 reviews by phone call. That's what you are if you're a C client. And you have to have $500,000 to become a C client. If you're less than C, you are a D client. And we're looking for ways to get rid of you because we don't think you're going to be very profitable. That's how they classify their clients. That's what you get. You're put into that classification. And it's not just a firm like this, because if you look at Merrill Lynch, they do the same kind of thing. If you have less than $300,000 in assets, you don't get a financial advisor. You're put into a call center. That's the way things are going, because as firms look at the profits that are generated on their clients, they're looking at how much more money you can add to move up to a next level. That's their focus. It's not on how well your account does. It's on how well your account makes money for the firm. And if you have $4 million, you make a lot more money for the firm than if you have $2 million or if you have $500,000. And that's true at AFC too. But we look at it in a different way. When I started early in my career, there was the same kind of system, and I was set up at a brokerage firm in the wirehouses. And my whole thing was to build up to 300 clients, and I had what I called the credit card. not credit card, but the Christmas card. At the end of the year, I would send out 300 cards. And if you weren't big enough to qualify, if your account was at the low end, you didn't get a Christmas card and you wouldn't be a client the next year. That's how I started out in the business. That's how a lot of financial advisors start in the business. I changed all that as I began to manage money because I realized that some of the small accounts I had, some of those accounts I can remember. I know of one account that was less than $30,000. Today, that's a $500,000 account. It didn't generate a whole lot of income when it started in 1990, but today it generates a significant amount of income. We look at it in a way saying bigger is not better. Just because someone is big doesn't mean it's all about being better. We believe that we're a small boutique firm, and even as we grow, the focus will be on maintaining that feeling of being a boutique firm. That's crucial to me. That's crucial to each one of our employees, each one of our financial advisors, each one of our staff members, maintaining that boutique feeling. We have clients that have come to us with $100,000 or $200,000. We've seen that grow. A client came with $600,000, would just have been one of those C clients, and they have added no money to their portfolio. None. That came $600,000 in 1998, and I did a newsletter, a case study, $600,000 in 1998. Today, that person's an A-plus client, not because of what they added, but the account has grown from $600,000 to $8 million. For me, that's tremendously gratifying to see what we've done for our clients. It's not that the clients have to put more money in to move up in categories. We don't have categories. We don't have an A-plus or a D or a C or a B category. We want our clients to feel like they're big fish, even in a small pond. Rather than being a small fish in a big pond, we want our clients to feel like they're big fish, that they can call me, they can call Jensen if she happens to be their financial advisor. They can call Sarah, they can call CJ. And if they want advice from another advisor, even though they're Jensen's client, they can call Chris or Al. They have access to every one of us. And by the way, I will take those calls. So will Sarah, so will CJ, so will Jensen. We're there for our clients. We want to be there for our clients because we feel that our clients, each and every one, deserves respect. Each and every one deserves validation. Each and every one should see their accounts grow and maintain over the long period of time. We say we have a passion to create and maintain wealth. We want that to happen for our clients. It's not a system where we want you to put in more money to move up the scale, to move from a B client to an A client or to an A-plus client. We want to help you get. If we had a classification system, we want to see you get there because of what we help you do in creating that cash. We want to treat everyone equally, and we want to deal with friends and family. There are firms, big firms that manage over $100 billion in assets that restrict the advisors from doing work with their friends and family because they don't want to see them in the grocery store. They don't want to have to answer for how poorly their accounts are doing. And there are times when we have downtimes. This year has not been the best year for us. Last year we were up 77%. This year we're not going to be up very many percent. We're going to trail the market, but I think that we're set. My gut feeling is we're going to have a very good 2022. I hope I'm right in that, but who knows? But we want each one of our clients to feel like they're respected and that we honor each one individually, and that they are a big fish in our pond. That's where we want to be. I find it humorous the way that other firms treat their clients. And if you're if you have a financial advisor right now, you should ask, am I an A+ client? Am I an A client? Am I a B client? Am I a C or a D client? You should ask that question. And don't necessarily believe the answer they give you, by the way. Who's going to say, oh, I don't want to tell you you're a D client. I don't want to tell you you're a C client. But be aware, the chances are very high, 98% in my opinion, that if you're with another firm, you're classified as an A+, A, B, or C client. Anyway, that wraps up this. Don't go away. We have another segment coming. Oh, we're finished for the day. See, when I get excited about it, how time flies. Have a good weekend and a good week. I'll be back next week.
You've been listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer. The preceding program was sponsored by Adams Financial Concepts.